Our next guest says the rise in zero to expiry options has dramatically changed the structure of the market. For more on what the options market is saying about the equity market, let's bring in Amy Wu Silverman, head of derivative strategy at RBC Capital Markets. I've had people say they check out CNBC, Amy, just to see what's going on, and they start hearing about reverse repos and the Fed. And we just introed you with a concept that even people that have been watching for years may not be familiar with. So let's go back to that and talk about how this has changed things. You're talking about options that people place that aren't 3 months out as far as when the expiration date is. They expire the same day, and they're very, very popular. Now, it's almost like gambling.
That's exactly right. And, to some degree, the gamification, Joe, of options started all the way back during the pandemic when we first had the meme craze. But, one thing I'll say is folks may not have heard of zero DTE, but zero DTE comprises almost half the volume of all S&P options that are traded. So the analogy I like to give is imagine if options markets were your GPS, and they used to give you about a mile before you had to make that left turn. Now they're giving you about 50 feet of warning because that duration continues to shrink. And when that happens, it's really changing the underlying structure of the roadmap that the option sentiment used to provide you.
Which have been pretty good, because you point out last time you were on, and I remember you talked about how bullish the sentiment was in options for small and mid caps. And, we know what's happened in the past 6 weeks or so. In looking at those indicators, you say at this point, not nearly as bullish, the sentiment that you had told us about, but not at this point yet signaling anything really significant as far as a sell-off.
Yeah, that's exactly right. So I think the last time we spoke, one thing I said was on IWM, which is the small mid-cap Russell 2000 proxy, we really saw sentiment go out of the ballpark, incredibly bullish to the point where, kind of the normal dynamics of options, which is that downside hedges should be a little bit more expensive because folks need insurance, had actually gone negative. We've seen that dramatically reverse. So again, it's not that people are starting to hedge IWM, but that really bullish sentiment has waned. So it could be an inflection point here from the rally we had beginning in November. We're really seeing that sentiment wane, not just on IWM, but also on the Mag 7 as well, in terms of that bullish sentiment really starting to wane.
And you actually make the point that, we're seeing the same thing in the Magnificent 7. And what I didn't realize, we can still use normal options. We still have the indicator there because there's none of the options you were just describing. The short-term ones, you can still use the Mag 7 now. You may need to use that for the whole market because you can't use that technique on those.
Yeah, that's exactly right. So obviously one thing about the Mag 7 is just their heavyweight ness, I guess, in the NASDAQ or in the S&P already makes them a good proxy. But what you're also seeing happen is this divergence between what you can roadmap from options in Mag 7, because there is no zero DTE, versus something like S&P, which is becoming less and less the signal. So to that degree, even though we're seeing breadth in the market, I think the importance of Mag 7 just doesn't go away. And it continues to be a place where folks are going to read the tea leaves, in particular in options, because they're going to tell you so much more and give you so much more of an early warning signal than something like S&P will going forward.
It's an election year. What usually happens? It's different than most years, even for you and for people that follow options.
Yeah, this is going to be an interesting year, just given kind of not only the political tensions, but I would say the legal tensions around the two primary candidates. Really, I was thinking about history, like what's the closest situation we have to this? I think we go back to 2000, Joe, to the hanging chads. And what did volatility do then? What did the market do then? No, I wish we didn't, but that was the closest proxy I could find. You see a big spike in volatility, kind of 10 to 15 points higher on headline VIX than we see now, and arguably, this year's election could make that look like child's play.
The one thought that I had when I was reading your notes was I'm trying to figure out whether we use a lot of this sentiment as a positive or as a contrarian indicator. And a lot of the times you say, so that's indicating that people are very, the options are setting us up and people are very bullish in terms of sentiment. Normally, you would think that's a bear signal when people get too bullish. But a lot of times the way do you take it as a positive correlation a lot of times with your work?
I do. I tend to think of it as a leading indicator. And as I mentioned, that's starting to shrink on S&P because people are able to place their bets, the same day. So you're getting less of that early warning signal, but that's not true for anything else. You still can place it 1 month out, 3 months out. And essentially the way I think about it is if you think something's going to happen 2 months from now, 3 months from now, you use something like the options market, which allows you to place a bet on something in the future. And so, I do think it's sort of a leading indicator in that sense. And we've seen that back tested towards time. So when you look towards history at where those inflection points came from the options sentiment, that does tend to lead the market historically.